Hey there, it's Miles Pitcher, Superior Lending. I wanted to record this video for you. Uh, I wanted to show you another option on your mortgage. Most of us are, when we think of a home mortgage, it's 30-year, 15-year mortgage, and that's very much what we're used to, and that's a great way to go. But I wanted to show you another loan that I've really enjoyed so much that I've done it on my own primary residence. So it's pretty cool. Let me walk you through it, um, and I'm going to go pretty fast, so we'll just get going along here. Okay. So yeah, I've been in the business for a while. The thing I like about this loan product, and I may say it's a new product, it just means it's new to us. It's been around for a while, is the flexibility that a conventional loan does not have. It solves some problems, gives flexibility, and it saves you a ton of money. Okay, so most of us have mortgages. We pay a whole lot. So these numbers may not match your scenario exactly, but you can see, and rates are lower than 4.5 right now, but we're going to pay a ton load in interest on our loans on the standard normal 30-year mortgage. Tuition costs are up, medical expenses, number one reason for BK. We're also finding that people are funding or paying more into mortgages than they are into their own retirement accounts. You can see that right here. Just some stats for you. Okay, this chart shows the typical mortgage. It really isn't until about year 22 when you change over from the majority of your payment going to interest to principal. The other thing that we know about a standard mortgage is once you make that payment, that money's not accessible again to you unless you do a refinance of some sort. So this is the way that we like, and it's pretty cool. So here's a quiz for you. What matters most when we're borrowing money, the interest rate or the amount of interest that you'll pay on the loan? The answer is really how much interest you'll pay on your loan. So let's show you this. It's, again, the purpose is to avoid a ton of interest that we're paying and to give you flexibility and to pay off your home sooner. So it's called an offset mortgage, has a bunch of different names. It's been around for a long time. It's been in Europe, Canada. Commercial loans in the United States use these. They're called zero balance loans here in the United States. So what it really does is it combines the mortgage with banking, okay? Because right now you may be saving up your mortgage payment, you may have some money sitting in the bank. That money, even if it is getting paid any interest on those savings, is very, very minimal. We all know that the banks aren't paying hardly anything on the interest on those deposits. So it earns a low amount of interest, and what we're going to do is we're going to move that over and reduce the principal balance on your mortgage. The money, we'll use some numbers here, will show that if we move 100,000 we've saved up over to an 800,000, the mortgage is going to drop down to 700,000. Okay. The great thing about it with this product is that it's a line of credit. You have 30 years of access to those funds in there. So what we create is a sweep account that any extra funds that are in your bank account, do a little laser pointer, any money that's in your bank account that's sitting not working, every night is moved over to pay down the principal in your mortgage. Those funds can also move back to your bank account if needed. You have, just like any normal checking account, ATM cards, checks, bill pay, 24/7 access to it. Okay. So deposits go into your checking account, and these are at normal banks, and then they're swept over, and it reduces the daily principal balance on that mortgage. Withdrawals can move right back out of that line of credit to your bank, and you can pull that money out and use it again, either for paying bills or whatever you need for your daily living. And like it says right here, money not spent from the account is always working to keep your principal balance lower, and that's what's going to save you money overall on this mortgage. So I'm going to just bring up these 5 benefits. It's going to save you a ton of money in interest. The equity in the home is going to build faster, quite a bit faster than a traditional mortgage. Usually it pays off the home in half the time or less. The cool thing is that equity remains accessible to you for 30 years. Okay? It allows the borrower to pay interest only when necessary. So if time gets tough, you can just make the minimum payment. The company we do this with, they've been doing it for years. They have not had a single one of these loans ever go into default. They have been absolutely fabulous. I can't remember the exact percentage, but it's higher than 90% of these people are paying off their mortgages at a very accelerated pace. So you can purchase homes with this, refi them. Minimum down payment's 10%. There is mortgage insurance if it's less than 20% down payment. Once you close, you get all these things: ATM cards, bill pay, all those things that you get at a standard bank. I'm not going to spend a lot of time on here. You can pause and read these if you need to. So here's how the line of credit works. Okay, so let me just click over. So for the first 10 years, your credit limit stays the same. And in our example, it's 800,000. Okay, then after year 10, the credit limit starts reducing a little bit every single month until when you reach year 30, the credit limit is 0. So in our example, your credit limit would reduce by $3,300 every single month. Now, visually, what this is showing is that every single month as we move along, money is moving in to pay down the mortgage. And then maybe you decide to remodel your home. The balance jumps up a little bit, and then you continue having deposits coming in, medical emergency, so forth and so forth. You can see that you always have access to those funds again. So there's 3 different term options here: 1 month adjustable, 3-year fixed, 5-year fixed. And this is all based on the LIBOR. You should Google that and see how stable and low it's been. The LIBOR right now is 0.182. Okay. The margin is either going to be somewhere between 3.25 to 3.75. That gets added to the LIBOR index. And there is a cap and a floor on this. So the floor is 3.75. So most of our clients right now are right at the floor of 3.75. The caps are 6% plus the fully indexed rate. So that usually puts it somewhere around 9.25 to 9.75 is the cap. So let's compare these two. This is really the good comparison here. So same amount of mortgage on a conventional versus an offset mortgage. Okay, this shows 5.22. That is way high. We're down around 3.75 right now, okay, where our floor is. 4.5 is a little bit high on a conventional mortgage, but this will still show you and demonstrate how powerful this is, okay? So between our 2 borrowers, we have 108,000 and 65,000 of income. 138,000 a year is what their living expenses are at, okay? What that means is every single month we're going to have $14,000 coming into their bank account, and that gets swept over and pays down the mortgage. Okay. The cash becomes home equity by paying down the balance. So even in month one, we've just paid the mortgage down from 800 to 785. Okay. The interest is calculated differently. It's calculated on the nightly balance. Okay. So check out this example. So it's $114 a day at 800,000. Now with that pay down that we just did, it drops down to 112 a day. So we just saved $2.07 per day after just one deposit. Okay. You don't have to go in and make a payment on this. Every single month they just draw out the interest that's owed. They calculate the full month's interest from the prior month, and then they automatically pull it out of the account. Okay. And then they just keep doing that automatically. So now what we're looking at here is we've just made that 14,000 deposit, and then we're going to have some monthly expenses that come out. Okay. And part of that also will be that we have the interest that automatically gets deducted. So now our balance has risen from 785 up to 793. Okay. The money that isn't spent remains available to you in that account as equity or residual cash. Okay. Here's what all of our monthly expenses may include. Okay. You're not going to spend it all in one day is the thing. It trickles out throughout the month. So if you can leave that money in your account, it reduces the amount of your mortgage and saves you interest. The money that you would set aside and budget for your mortgage is going to be able to sit in your account and help reduce interest. Yep. And it just, all these things help contribute to lower the interest. Okay. So we have 6,900 of equity after month one. Okay. Then we make another deposit. Then we have our expenses that go out. I went by that a little quick. Yep. So that includes our living expenses and the interest payment. Okay. Now our equity is getting lower, our loan balance is lower and lower. We have 10,400 in equity. Okay. Then we make another deposit, and then we have another month of expenses. We have the interest charged in there also, that's included. You can see how this is moving down, and after 3 months, our loan balance is down to 785. Okay. We are, in those same 3 months, a conventional mortgage balance would be down to 796. You can see that we are ahead by over $10,000 over the conventional mortgage. Okay. This is a great slide to show how we get ahead. 2 years, 7 years. Look at the balance difference here. Look at that. And see how much savings we are having in this loan. And then 30 years versus 13.3 years. Okay. Our model that we have right here would have the loan paid off in 13.3 years. Yeah, we saved 16 years off of the mortgage. That's massive. Yeah, $355,000 saved. Okay. You would have paid 82% of your payments right there. Wow. And look at that. Huge, huge savings. So, as you can see, a traditional mortgage just steps down. Our offset mortgage will keep zigzagging like this, but our balance is moving down. So, is this right for someone? And you have to ask that question yourself. But the key thing on all this is that it needs to be a borrower that is cash flow positive, right? If you're a person who is maxing out cards, carrying high limits on your credit cards all the time, this is not the right program for you. This is the person who uh, gets ahead every single month. Okay. I like it because I'm able to put all my free cash in there, reduce down my mortgages, my mortgage on it, saves me a ton in interest, and then I just draw out my monthly expenses. I actually just use a credit card for all my monthly expenses, and since I have 30 days of free interest on that credit card, I delay till the credit card's due, then pay off the full credit card at once. It leaves my money in the mortgage working longer for me. So this just shows you the simulator. We'll take you through it, and we'll actually give you access to it so you can play and work with the numbers in here. Okay. Questions? We'll talk to you about it. Thanks for taking some time. I know this was long, but I just wanted to introduce it to you. So as you're weighing out your 30-year mortgage, your 15-year mortgage, or whatever you're looking at, this is a great way, a product that will give you flexibility and access to your funds in the future. Let me know any questions you have. Thanks.